Yeah, good evening and welcome to this session. I guess on a Saturday evening, if you've come here, you know, it means that tax is sort of impacting us quite a bit. Okay, and so that is something which all of us uh, look forward to the budget to see. Has it been beneficial, not been beneficial, etc. And this time, there is a lot of stuff. Okay, and so let us get through it. Also, I think this time we also invited some of our, you know, people on the distribution side also to join, apart from some of our clients. So welcome to them as well. Okay. Uh, so yeah. So are you able to hear me well?
Yes, sir.
Okay. Okay. Fine. Okay. So yeah. So basically, getting on to the presentation. Okay, first I thought let's capture it, so broadly we're keeping it in two different sections. One is to look at, what are the impacts on the economy, the impacts on, sectors, and the impacts on our stocks and on our PMS. So that is one portion. The second portion, that segment that one is looking at, is what are all the tax changes that are sort of coming through. Uh, I will try and run through so that we have time for question and answers, and so we can make it slightly more interactive. Uh, because otherwise, taxes is a very, very boring subject. I wouldn't typically come and attend it also, Saturday evening, right? So basically, to start off with, we have the macro picture, uh, and I think that's been fantastic from what the Indian government has been doing. While globally, there's definitely, governments are not very fiscally prudent. They preach it to all of us, but I think our Indian government has followed through on that direction, and clearly looking at bringing fiscal deficits under control. Yes, post COVID, there was a bit of a impact, and so that is something that is also there's a strategy towards bringing it down. Yes, we've had periods when the deficit was much lower. Okay, but COVID did see a bit of a reset out there. So, but that's a reality, and I think that's also where the government is moving towards. The other part of it is about the spending that is there. Interestingly, government spending is important for the economy. Okay, because what happens is that if they spend more, then there is that much more activity that you have, and so it's a good thing to see spending. Of course, the question is whether that spending is within fiscal prudence or not. You would find that, let's say, in FY21, for example, you had a big spike in spending, and that is something which sort of, you know, reason for the fiscal shift that had happened. Okay, but again, I think it's broadly in the range. So if you see total expenditure, I think has been broadly in the range. What the government has been talking about is increasing the rural spending, and that you would find that has been a big jump, and possibly with state elections around the corner, etc. Right? I think that is something which was to be expected. But I think that's also a good thing, because how do we have a country which is inclusive in terms of what how we are. Again, I will not spend too much of time on this. You did speak about the spending, and which has been reasonably strong. But also the good part is you will find that also the receipts also have been growing at a decent pace. So that is something which is also there. Uh, so before we move forward into sectors, etc., I just wanted to trigger a poll, Tara. So if you can run the poll. My point is, in your view, right, what's the likely impact of this budget on your portfolio? Do you think it'll be positive, will it be negative, or you feel it's neutral? Yeah, so this is turning out to be, of course, a very interesting one. Okay, right. We'll give another few seconds and then we can maybe close the poll. Yeah, uh, we can end the poll. And yeah, so it's interesting that there are so many of us on the fence and who believe that it's going to be neutral in terms of the budget in itself. Um, Earlier it was neck to neck, but afterwards, finding that a lot more have voted for positive, about 32%, saying that it'll have a positive impact, and 22% saying that it may have a negative impact. Uh, like while 46% is in terms of the neutral side. Yeah. So moving on now, uh, that's also interesting because if you have a look at it, I think the budget has been reasonably growth oriented, and that's what we like about it. So on our portfolios, one believes that we will have a reasonably growth oriented budget, and it'll have a reasonably good and positive impact because some of the concerns that industry was having and investors were having basically was, will there be a slowdown, in terms of the spending, or the other extreme was also there. There were fears that will it be populist? Because if it's a populist budget, then you may have fiscal deficits coming out there. Uh, I saw a few hands being raised, and we'll come back and spend time, purely on, uh, your question and answers, and we'll circle back to you. Uh, so that let's finish off the formal part of it, and then take your questions. So the sectoral impacts, if we look at broadly across financial services, across say you have the MSME has been given a bit of a thrust out there. So it's a in some form there is a little bit of populism because they're trying to say how to have a larger impact on people. So the MSME side is one. Uh, then you have the MSME is basically the micro, small, and medium enterprises. Okay, so they have there are more loans coming. The limits in the Mudra loan is up from say 1 million to 2 million, and they're trying to make credit more accessible for them. And of course, this will benefit the banks and financial institutions which are focusing on MSME, and there are a number of them. So the second is, in terms of affordable housing, you have the benefits out there. Similarly, uh, the financial services is going to get, the question is it going to get impacted by the increase in LTCG and short-term capital gains? One does not think that it will have a direct impact and people is stop investing because the tax increases. Yeah, what may happen is there'll be that much lesser in your pocket to the extent of the taxes, but I don't think it'll influence behavior. It's not so large that will influence behavior of people actually investing in itself. So that is, we think, not going to have an impact. And yes, on the gold, uh, there have been, custom duties have been significantly reduced, and also the agricultural infrastructure and development cess has been also reduced. So you will find that total customs duty actually on gold imports has come down from 15 to 6%. That's a huge, huge move there. Yes, it's interesting. It'll benefit a few companies. It'll have impacts on a few companies. So if you look on let's say the financial services sector which are giving gold loans, it will impact because to that extent, gold prices will come down and it will impact your loan to value ratio. Of course, in the medium to long term, we don't think it's going to have a larger impact because our view is that gold prices will continue to go up. So that may sort of compensate for some of the fall due to the taxes being low. Okay, see, you also have the performance link incentive schemes, and the government has been sort of bringing that in, and especially trying to see how, exports, etc., can sort of get uh, benefited, okay, and thrust towards exports. So auto ancillaries, will continue to have positive benefits out there, okay, and even there's a bit of a thrust around, electric vehicles and stuff. So that's also going to benefit, some of them on the EV side. Uh, Power is the other place that, there have been focused towards. Okay, and of course there have been concerns on the PSU, the power companies, and even there are financial services companies focused on the power sector, etc. So the focus of the government there is going to have a positive impact on it. Uh, in terms of other sectors like cement, again, with a whole lot of focus on low income houses and building in rural areas, etc., etc. We think sectors like cement will see demand being bolstered, and similarly other you'll find pipes, etc., building materials will also benefit from the for the same reason. Uh, yes, infra and industrials, uh, the budgeted capex is higher, so it may get some benefit there, but there's not too much of a tax specific benefits. But I think the more important one is on the spending side, and that will impact infra companies there. So I think that will continue, but there's nothing specifically different that will come in from the budget. The healthcare, there have been a few exemptions from customs for cancer drugs. So these are very specific to certain areas, and there would be benefits in those companies who are in those specific areas, including you have, some bit of stuff for the diagnostic side, radiology, and some of them on the X-ray machines, etc., will benefit from. Insurance is the uh, other place where relatively because of the capital gains getting changed, and you have a certain uh, up to 2.5 lakhs, it's exempt from tax capital gains. Then, ULIPs and will probably benefit from there. You may also find that, there's some benefit from the ATCCD where, contributions uh, or deductions limit has been increased to 14% of salary. So that's the other thing which will sort of money will go to the NPS companies out there, and most of them are typically insurance companies as well. So that's something that will benefit there. So broadly, on the technology side, there will be some issue on buybacks, okay, because that is now sort of subject to tax, and it's made on par with dividends. Uh, Consumers is the other place where there have been tweaks around, and gold definitely will have a benefit on the consumer side, and some of the push on rural spending, job creation, agricultural productivity, etc. Are ones which will give a thrust to demand from rural India, and probably be positive for consumption. Chemicals also, there has been certain duties for specific chemicals which have been you know there out there. And oil and gas and fertilizers, we believe, is not going to be impacted as much. So, what is the impact on our portfolios and the companies and stuff? We believe that we have a number of things which will sort of benefit from. we have exposure to in our portfolios to some of the stocks in the jewelry business, and those will get benefited. We have a reasonable exposure to building materials, and that has will be positively benefited, and consumption as well. Okay, one of the things that we are highlighting here, because we don't have too much of exposure to PSUs. We did have, and we also sort of brought that down. And our point of view there is that valuations are sort of going up, and you can see from FY22 to currently, there's been a good spike in valuations out there. So one needs to be watchful of that. And the expansion that happened in PE, has benefited investors. Now, we believe the future will be driven by earnings growth rather than too much of increase in the price earnings ratio and the valuations. So that is something why that's a reason why you need to sort of be selective and look at PSUs which are sort of beneficial there. Yes, on the PSU side, we did have one of the stocks which delivered almost like 2.6x in 7 months. So in our multi-bagger framework, you know, uh, one of the things that we invested in, one of the ones that worked for us was a PSU company. And when we found it, really, vertical rise, we did say book profits on it and moved on from there. So some of it, we will continue to keep working on our portfolios and studying stock by stock. We have the whole journey is, we've mapped it into a process, the four different processes that right from screening to evaluation to risk management and valuations, all of them, the whole journey we've brought into process. And I think that is something that we believe we will continue to keep doing. And as we go forward, we don't mind, there are periods when we like to outperform, there are periods when we don't mind being in line, say, with the index growth, and we will not chase returns in certain phases. I think that phase, as we go forward from here, we believe there is some bit of upside there which is left, but slowly we will, start going to better and better quality, and we will start, also seeing how to reduce risk, etc., when we think that valuations are stretched. So that is something that is important to us as Right Horizons and our philosophy of delivering risk managed returns, and that is something that we will sort of continue to do. That brings me back to the second segment of it, which is on taxation and asset allocation, and and I think this is something where I think a lot of people are wanting to know what is the impact on me. So before again we get through with this segment, I thought let me run a poll. Okay, and what do you think is the likely impact of this budget on your taxes? Okay, positive, negative, or neutral? Okay, so we'll give you a few more seconds before we look at it. Okay, so here we go. Yes, so we have almost like here is very interesting. There are a lot of people who come back and say negative, and that's 48%, and the rest is split between positive and neutral. So yes, I think there is definitely going to be an impact, and the capital gains increase has been a bit of a disappointment. Okay, and also, especially like apart from the equities, the capital gains on the real estate also has been is something that we will also talk and discuss and see, what is the impact out there. Okay, so we'll move on. Okay, the first, let me start off with the positive side of things. And the positive side is that, you have, um, tax slabs under the new regime, which have been sort of tweaked around. and so that they've been increased, and one would get a benefit from that. And apart from that, you have the standard deduction. If your salary, has been increased by 25,000 rupees. So both of which will, result in a revised, a lower tax of 17,500 plus charges and cess, of course. So that is something which is a clear benefit out there. But in fact, I wonder, a lot of the time when government says simplification, actually, I've captured a summary table here because, there are so many things under it, so I must say that this is not comprehensive. This is more for a presentation template that, we're trying to make it crisp enough. But yes, what is it that has been a major impact? One of it is that, in terms of on the short-term capital gains on stocks, and we try to capture, sector by sector. Okay, so both, I think broadly you'll find the stocks and equity mutual funds will be similar, right? There's no change in holding period, whereas for some of the others, there's a bit of a change in holding period. And but there has been an increase in short-term capital gains from 15 to 20%. Okay, so that's been, in fact, uh, the percentage impact here is going to be significant here because it's not a small. 15 is directly moved up to 20. And if you see on the long-term capital gains, you find that what was earlier 10% has become 12.5. So basically 10 to 12.5 on long term and 15 to 20 on short term. I think that's the key impact that you have out there, and that is there. Yes, the debt, uh, earlier it was made that debt is at the slab rate. Okay, so the capital gains benefit was taken away. But now there's something that has slipped in there, and which is why I say it's so complex. Where it's, if you have a mutual fund with above 65% equity, it's treated as an equity fund, right? If you have below 35% of equity, then it is categorized under the debt. So between 35 and 65% equity, this category which has come up because of the way the budget has worded it. Okay, and that is something which also is interesting for us, when you look at what is it that we need to do differently as we go forward. On equity, on stocks and, equity mutual funds, there's nothing much you can do. I don't think you are going to, stop investing because of, a bit of a higher tax. But and at the same time, even at 20% short term is still lower than our marginal rate of tax, right? So that is a good part. But what is it that you can sort of evaluate now? I think there's something that we will start looking at on the non-equity mutual funds, which comes between this 35 to 65% equity range hybrids. I think there, it may make sense to look at some of those funds. Say if I have a fund with little bit of equity there, so a conservative hybrid is something that maybe we can look at, but the conservative hybrid has more than 35% of equity. So I'm saying balanced funds can be something that we need to look at. The other thing that I think is sort of interesting, keeping in mind that debt is added back to income, we need to look at, say, bonds, listed bonds, okay, that is at a 12.5% rate of tax. The only point that we need to keep in mind, this is capital gains, right? If they are giving you an interest, that is added to income, and there's no change on that. But on the capital gains, so on ones which are paying out interest on a periodic basis, the difference is not going to be much because most of your returns are going to come as interest, and capital gains is going to be a smaller portion, so it's not going to be as much. But you know, uh, zero coupon bonds, etc., are ones which I think we will try to see how to look at it. Yes, the other is REITs and NVEITs, which are sort of coming into prominence, are at similar to equity, which is 20% short term, and in the long term, it is 12.5%. The great part of it is that the tenure here has changed. Okay, so because they've said listed, and so, and unlisted, they've brought two categories, 12 and 24 months. So what was earlier 36 months has come back to sort of 12 months. So this is, I think, a big positive out there. And REITs and NBITs also are something which I think, can become a slightly larger part of one's portfolio, or at least introduce it into a portfolio, keeping in mind now that debt is, taxed at the marginal rate. So equity fund of funds is the other place. So I'll not go into too much of these. Maybe I'll spend time on gold and also gold funds. Okay. So basically, gold is, and silver is, at 20% uh, as per the new short-term capital gains, and the ETFs, etc. And you'll find that otherwise it is, 12.5%. Earlier, you'll find that a typical gold fund, not an ETF, etc. Has a different thing out there. So this is something that is what one can sort of look at, but this is similar. So gold, ETFs, etc., similar to what you have on basically the equity side. Now, coming to all unlisted assets. So the listed and unlisted, so all unlisted assets have been made as 24 months. Okay, so yeah, you get a benefit there from, let's say, physical gold, which was earlier 36 months, is now 24 months. Of course, I don't know how many of us report, physical gold sales or exchanges, etc. But so it's not going to impact us as much. And I think as a habit, we are not also selling gold too much. We buy it and then, it's there for life. Okay, so the second is, I think, but what is the big impact here is real estate. So real estate basically, earlier also it had a 24-month period, so that has not changed. But what is the change that has been made is what was 20% after indexation for inflation, okay, is now 12.5% without indexation. Okay, now, and this is where again I say it's definitely not simplification, because I'll run you through a table that is there, and you actually have to compute it and then see what is it that works for me. Okay, and how do you plan for it? I think it's really difficult to do that. Okay, but that's the unfortunate part of it. And I think what is an established one, I thought a good principle. If you ask me, this is something that we have been disappointed about. One hopes that, and I think there have been representations to see whether, indexation can be brought back. Okay, but that is something that we'll have to see whether changes are made there. Uh, Bonds unlisted are tax inefficient because, they are at a slab along with the debt funds. So that is something. Unlisted equity also is something where now the STCG is, say, 12 and a half, sorry, the LTCG is, long-term capital gains is 12.5%. So, so broadly, many of those have got categorized in the 12.5%. So that's a good thing out there. Uh, Earlier there was thing equity and non-equity. So many times some of the foreign securities, were under non-equity, yeah, but you had the benefit of indexation. Okay, the issue is that while it looks that it's better, unfortunately, indexation sort of takes it away. But and when does, uh, the new regime work better? We will come back and we look at a scenario around that. Okay, and because it's a big enough one, so we're looking at, gold specifically, and real estate and stuff like that. What is it? So let's assume, because most of us will be bothered about the real estate side. So if you are holding, we will look at different, and this is something that an illustration that CLSA had given, and this is why I'm saying it's so complex, right? So that at 5% CAGR, okay, if your property price goes up by 5% per annum, okay, you will find that. So what is showing in the gray, right? And what is the difference? The new regime versus the old regime. If this is positive, it means the old regime is better. So, okay, negative, minus means the new regime is better. Okay, so you'll find that in all of these cases where your house price increases 5%, okay, your new regime is significantly worse off. Okay, so that's the worst part. You have a house which is not delivered great, price appreciation, and on top of that, you have a far higher, outlay of taxes. So if that goes to 7.5%, of course, then keep it. And here we've assumed the indexation. I think they've assumed a 5% or something like that. So that has been, I think as it goes to 7.5%, you'll find it is 65% higher, okay, in the new tax law, okay, in terms of capital gains. So that is one thing that it goes. Again, if you see as it goes to 20 years, from there again it goes back to almost like 96% out there. And which is why today you need to look at a combination of what is the return that your real estate has got and what is the tenure that you've held it for you to see what is the benefit. Okay. So when it is minus, it is beneficial in the new regime. So you'll find that when house price increases by more than 12.5% per annum compounded, then it will do better. So it's unlikely to be beneficial for most of us on the real estate side. It may be beneficial for, if you have unlisted equity, or you have, you know, uh, where the price appreciation can be much higher, or even international equity and stuff like that. In those cases, you may find, okay, that it is sort of beneficial in the new regime, but the bad news for most of us in most scenarios is actually negative. So we've looked at it, typically, because sometimes there are a lot of concerns from clients as to, okay, is that going to impact portfolios too much in terms of the increase in capital gains? Okay, we looked at, different portfolios of ours, and so it a little bit it depends on what the returns are, right? So if the returns are higher, which is where you will find the old also is higher, as we go from a large cap to a flexi cap to a mid cap super value, with being a mid cap portfolio of ours. Okay, and it is some of them have been very, very good, returns that you've seen in the recent past. Okay, but we look at it sort of in the long term. Actually, the tax impact is, something like 0.3 to 0.4%. Okay, so it's not as much of an impact as people are anticipating. But yes, from our side, while we are managing the funds, because the short-term capital gains rate has gone up by a significant percentage, we would be a little more careful in terms of looking at the long term. Okay, and I'll give an example. In the last year, I spoke of one of the PSU that we sort of exited. Okay, and it delivered almost 2.6 times, 2.8 times in just about 7 months, and we got uncomfortable with the rate of change and how it was moving forward, and we exited while it was short term. Okay, now in cases like that, we may just try to say, okay, can I now drag it on and, look at it? Because earlier it was, the difference between long and short term was not too much for equity, 10 and 15%, right? So we felt it is better to take the gain rather than, optimize. But now we will also look at it a little bit carefully to see, and what is it that we do. Okay. In terms of so coming back in summary, in terms of asset allocation and stuff, it's a little bit positive. Relative taxation is positive for bonds and gold. Okay, so that is something which is there. But listed equity, real estate, and even arbitrage funds, that is something which uh, will not be as much as of interest. So I wanted to, keep it shorter. Otherwise, going through numbers and each of the sectors and all of it would have been cumbersome. So I said, let's do a quick one and then take basically all questions out there. So in summary, what is it about the budget? Yes, it's been a growth-oriented budget, and I think that's fantastic. That will also mean that possibly, the earnings will be good, and you will find that companies will do well. and hopefully the stock market also will do well for you. So that's so equity is as an asset class. We think so. It's in the right direction, in the right place for India and where it is placed. I think that is a good part. The other part of it is in terms of the government has, and we love this because the government has been fiscally prudent. If it is if the government is indisciplined, it creates a lot more potential threats for the future. Okay, because as your loans keep piling up at a government level, you will find that it adds more and more stress as we go forward. It adds inflation, and it creates uncertainty out there. We've seen scenarios in the past where you know India had to go to the World Bank and IMF, etc. At certain points of time. So I think being fiscally prudent is always a good thing. Okay, so how do you find that balance between because when you're fiscally prudent, you are not necessarily gunning for growth as much. Okay, because you may spend more as a government and you know uh, get growth in the economy even faster. But when you do that, it catches up with you in the long term with inflation and other impacts. The slab changes have been beneficial. The higher deductions also have come in there. So, it's the government is trying to go towards, appeasing the common man. And I think that's something that is an impact there, which is positive impact. Uh, the custom duty on gold and silver has been significantly reduced out there. So that for, you know, people who buy gold and the ladies, I think it's a welcome thing. Uh, uh, I know a lot of people must be going to buy jewelry right now. Okay, so that is something which is there. Uh, Long-term classification has also they've brought about clarity. Listed securities now is 12 months, and other assets are 24 months. Earlier, you had a 36 months as well, and that has been taken away. So it is good. There were talks about increasing the tenure, right? So for long term, and that has not changed, which is good. Okay. The negative is definitely higher capital gains on listed equities and equity-oriented mutual funds. Equity also is increased for FNO futures and options, and that's going to impact people who sort of trade on FNO. You also have buybacks which are sort of going to get impacted. Okay, real estate, one spoke of, real estate is another place where apart from equity is going to have a reasonably large impact there. Uh, uh, and so that's something, indexation going away is negative, like I mentioned. And so what is it that we need to do based on a budget like this? Because there have been changes. Unfortunately, what is simple actually for the government is, uh, I would say, 20 rows of different assets and almost 4 or 5 columns, in terms of what is the tenure, what is the short term, what is long term, and all of that. There is complexity has increased quite a bit, but I think what is it that one can do? We have to step back and look at it and see, is there something that we can do without impacting our risk profile too much, and we increase allocation to uh, certain assets and move some of the others down. And an example that I was giving was, a conservative hybrid, which has above 35% of equity, is something that one can sort of, evaluate.